In the long term, I actually agree with that. But what happens is people start to invest in something thinking that they'll get paid out so quickly, and it's generally not like that, right? And that's when you know you're getting to a top, when someone's like, oh, I'll just buy gold and make 10% in a month. I mean, for those of us that have been in gold for a long time, we know it's not that easy, right? You know, it's definitely not that easy. And so once you get that mentality of like the gambler's mentality, like, oh, just buy calls on gold, it'll just magically be worth 100% more in a day. That's where, to me at least, it gets a little lofty, and it needs to shake that mentality out. Once it shakes it out, I think we repeat exactly what happened here, which is this pullback, sideways chop, and then the next move up. And so kind of if we just game this out, right, and let's just say we go to the measured move, you know,
Gary Wagner, a veteran market analyst, believes gold is entering one of the most critical phases in modern financial history. According to him, the recent rally is not just a reaction to inflation or geopolitical tensions. It's the market's deep-rooted acknowledgement that the global economy has reached an unsustainable point. Central banks, burdened with record debt and fading credibility, are quietly shifting toward gold accumulation, signaling that confidence in fiat stability is eroding from within the system itself. Wagner points out that as real interest rates turn negative across major economies, investors are rediscovering gold not as a trade, but as a form of monetary insurance against systemic failure. He emphasizes that technical patterns now align with fundamental drivers, forming what he calls a perfect convergence. Breakouts above historical resistance levels suggest that gold is no longer bound by traditional market cycles, but is responding to macroeconomic distortion. The metal's strength amid fluctuating yields and volatile currencies highlights its independence from short-term speculation. Wagner argues that once gold sustains momentum above key psychological thresholds, it will trigger institutional repositioning on a global scale, transforming gold from a hedge into a necessity. Looking ahead, Wagner foresees gold advancing into uncharted territory as the world transitions from confidence-driven liquidity to collateral-based value. He predicts that a combination of debt restructuring, de-dollarization, and continued geopolitical instability could accelerate gold's climb toward new record highs. For him, this is not a rally to trade. It's a historical turning point where gold reclaims its centuries-old role as the anchor of trust in a collapsing financial system. Now, let's dive into the clips to hear these insights firsthand. Don't forget to like and share if you find this valuable. Your support helps spread the word.
Basically kissing it today, we get a down move, and then we go sideways like this, and then we can make a move up. And that at least to me would be what I would think. Now, it could be a little bit deeper than that. My guess is it's a bigger pullback. This was a bigger percentage pullback. In fact, let's do that math. And I'm just literally doing TA right now with you guys in this. But let's see, what was that pullback percentage-wise? It was a 9% pullback. So what would a 9% pullback be if we replicate that? It would be back to about 3,800. So 3,800 would be a downside potential target there. You guys see what I'm doing there. So just some cool technical analysis.
So the fact in China, I believe, is one of the larger purchasers of gold. Even though they produce a tremendous amount, they continue to buy from the open market. And that gold will stay in the central bank of China for a long time.
Look at this. Gold has basically had two moves in 2025, right? I think we can all agree it's been a story of two moves. One, right? And two, with a whole bunch of chop in between, right? In between here. Okay, so there's two moves. And so the idea is in technical analysis, there's symmetry. And symmetry comes in because human nature generally wants things, like even if we don't admit it, we like when things are neat and tidy. It's just subconsciously we do, right? We like our houses in a certain way. We like this and we like this, right? So one of the things I was doing, I said, okay, well, if we take the beginning of this move in 2025, right, and we map it to the highest point here, and then we take that to the beginning of this move here, well, so we're starting right here. This is the beginning of that move. Where is your target? And this essentially gives us 42.35 would be a measured move. Now, again, there's no guarantees that that's the top, but in terms of technical analysis, that's the line now in the sand for me. That would be the measured move. And I just want to show you guys here, which is pretty cool here. So if we do the same sort of thing over here, going back to 2024, and we, basically 2024 was very similar to that. if we so he's the beginning of the move up, right? And then if we take this and we look at it from the beginning of this breakout to the upside and we extend this out, look at that. See that? Now, is that cool or what? And so essentially what I just showed you is that that is a perfect measurement. The measured move is replicated right there. 2 moves up and then measure. Now, listen, the time frame it took, this was a lot longer. This is a lot shorter, but here was a little shorter. But the point is still the same amount, right? The same general amount. And that's now being replicated here to here. And then you can see what happened. Gold pulled back right here, chopped, and then eventually broke out. And that's kind of, in general, that's what I'm expecting on gold. Like I am expecting a pullback. There's no doubt about it. I mean, it's gotten too lofty, too many weak hands, meaning that people are just chasing it because they think it's like a no-brainer money investment just to go long gold. And in the long term, I actually agree with that. But what happens is people start to invest in something thinking that they'll get paid out so quickly, and it's generally not like that, right? And that's when you're getting to a top, when someone's like, oh, I'll just buy gold and make 10% in a month. I mean, for those of us that have been in gold for a long time, we know it's not that easy, right? It's definitely not that easy. And so once you get that mentality of like the gambler's mentality, like, oh, just buy calls on gold, it'll just magically be worth 100% more in a day. That's where, to me at least, it gets a little lofty, and it needs to shake that mentality out. Once it shakes it out, I think we repeat exactly what happened here, which is this pullback, sideways chop, and then the next move up. And so kind of if we just game this out, right, and let's just say we go to the measured move, we're basically kissing it today. We get a down move, and then we go sideways like this, and then we can make a move up. And that at least to me would be what I would think. Now, it could be a little bit deeper than that. My guess is it's a bigger pullback. This was a bigger percentage pullback. In fact, let's do that math. And I'm just literally doing TA right now with you guys in this. But let's see, what was that pullback percentage-wise? It was a 9% pullback. So what would a 9% pullback be if we replicate that? It would be back to about 3,800. So 3,800 would be a downside potential target there. You guys see what I'm doing there. So just some cool technical analysis for you guys, again, for you guys out there. Let's go to silver. We're running out of time here. Silver did not confirm the breakout yesterday. Today, it could confirm if it closes above that previous high. That could confirm a breakout. If that happens, then again, upside, you got to look for your next resistance level on silver. Next up, let's look at oil here. Oil getting a small bounce, still an unconfirmed breakdown below trend line, bounce, didn't confirm so far, hasn't confirmed. I'll keep my eyes on that one there. But again, ultimately, if oil confirms, it should head down to $55 or so per barrel. And then lastly, nat gas. This was a great example of how people can get whipped out without knowing the confirmation signal. Here's your close above. It didn't confirm, and look, price came down. So if someone, let's say someone was short natural gas going into this, a lot of people would cover their short being like, uh-oh, breakout on nat gas. Nope, they didn't know the confirmation signal, and if they had stuck with their short, they'd probably be in the money right now. Same thing on the long side. Maybe people were watching and saying, all right, if it gets above this level, I'll go long. They go long here. Oops. Down it goes. So just again, reiterating how important the confirmation signal is, at least to me as a trader. And that's all I can do, guys, is basically just talk to you guys and tell you what I use, right? These are the techniques that I use every day to analyze the markets, which don't make me not have losses. Everyone has losses, but at least they make me have a high win rate. All right. That makes me, 75, 80% win rate, which over time, it can take care of itself, right? Essentially, that's what we're trying to do in this game. Diversify, and understand that anyone could be your loser. But if you can trade enough times, 100 trades, I should be able to get 75 wins.
Gareth Soloway, known for his sharp technical and macro insights, views gold's current setup as the calm before a powerful revaluation. While markets remain distracted by short-term movements in equities and crypto, Soloway argues that gold is quietly building the foundation for an explosive upward phase. He identifies the long-term consolidation patterns as evidence of suppressed energy, a coiled spring waiting for a catalyst. That catalyst, in his view, will come when central banks lose control of inflation expectations and investors rush toward tangible value. Soloway also highlights the psychological aspect of the market. He believes most retail investors have grown numb to gold's steady climb, assuming it has peaked, while institutional players are quietly accumulating at scale. This behavioral divergence, he notes, often precedes major price surges. As liquidity pressures intensify and major currencies weaken, Soloway expects gold to break decisively through resistance zones and move into a new era of price discovery. His analysis suggests that once gold moves beyond its current trading band, the ascent will be rapid, not gradual, driven by fear, capital flight, and loss of confidence in fiat systems.
Well, the one thing you have to take into account with central bank accumulation of gold, rather than dollars, hard currency, which was the case years ago, central banks tend to buy, accumulate, hold. They don't sell. Mm-hmm. So anytime you get a central bank accumulating more gold, that's going to stay in their reserve. They're not looking to liquidate it as much as use that as an instrument to provide value. In other words, the liquidity they need. And so it's important to note that when central banks are accumulating, they're going to hold on to it for a while. So that will diminish the supply. And of course, that will accelerate the upside move. Mm-hmm. So the fact in China, I believe, is one of the larger purchasers of gold. Even though they produce a tremendous amount, they continue to buy from the open market. And that gold will stay in the central bank of China for a long time. It's not something, they're not speculating. They're not looking to accumulate and then sell. When they buy it, they keep it. And so that will tend to tighten the supply. Yeah. Supply and demand economics, when supply diminishes, price can only move one way, and that's higher. And so that would be a very, very positive factor for gold. The more central banks are accumulating, the tighter the supply will get and the higher gold will go. The demand is stable, and if anything is growing. I talked to one of my clients the other day, and he buys physical. I said, well, where do you purchase it from? I was hoping he would say Kitco. That's one of my trusted companies that I buy my physical. He said, Costco. I said, Costco, really? He says, yeah, the problem is they limit how much I can buy, and they're typically sold out within days. And so when you're able to buy gold and silver at Costco, it has reached the saturation level where the public has gotten very, very tightly involved with what's going on. That is a very, very strong undertone to continue the bullish market sentiment. Listen, it's not the norm because there is an inverse relationship between the dollar and precious metals because the precious metals are paired against the dollar. However, you can get scenarios where the dollar's moving lower and gold and silver are moving lower. Typically, any kind of dollar weakness is going to have an identical effect on gold and silver. Dollar weakness is going to turn it on its back, so to speak, and that's going to lend strength for the precious metals. An upside move in the dollar will simply give it strong headwinds that it needs to overcome to have an equal move. In other words, if the gold gains $20 in dollar neutrality, but in one case the dollar has moved up 2%, well, gold has got to move up 2% to just be neutral before it can show a gain. So you can see the dollar have strength and gold and silver move up. And when we look at this daily chart, you can see that the dollar moved from 96.69 up to 99.46. So it's moved more than a couple of percent, and yet gold and silver continue to move up, and in fact have moved up during the period of September here. So it's just headwinds that the metals have to overcome just to break even. And when you see dollar strength on a day when gold was up, realize that gold first had to overcome the dollar strength to show any kind of positive. Talking about physical accumulation, you should have built a base already and you're adding to that base at a more expensive price. So your dollar cost averaging to the upside, which isn't as favorable as dollar cost averaging to the downside. But of course, if gold is moving down and you continue to buy those dips, the inventory you had has less value. But an old teacher of mine used to say the price of gold or silver doesn't really matter if you're holding. It only matters at two periods: when you're buying and when you're liquidating. If you're holding, the value of a coin is still there. The value of a 10-ounce bar is still there. The value of a kilo is still there. And it's not a question of will it gain value in the future. Over time, typically, when paired against a fiat currency, it can only move higher because gold has intrinsic value, and the dollar is backed by what? The faith in our government. As long as it allows you to pay bills, to transact business, it is the mode of commerce. People aren't going to buy a house and trade, 6 camels and a horse. That doesn't happen. They're going to use dollars to do that. But gold is always going to have a intrinsic value, and as long as we're pairing it against a fiat currency, whether it's the dollar or the euro or other currencies, over time, the intrinsic value of gold, let's say that maintains at a level pace, but the currency itself is going to go down in terms of buying power. I'm not referring to the relationship of dollar strength or weakness against other currencies, which is what the index does, but the inflationary pressure. So what does it cost for a loaf of bread, a gallon of milk, a gallon of gasoline, things of that nature? And as long as fiat currencies are being used to transact business, over time, it takes more currency to purchase the same amount of a commodity. And that's not going to change because the currencies aren't backed by anything except faith in the government. They're not on the gold standard. That's long past, that train is run and past the station, so to speak. So the fact in China, I believe, is one of the larger purchasers of gold, even though they produce a tremendous amount, they continue to buy from the open market. And that gold will stay in the central bank of China for a long time.
In his longer-term outlook, Soloway foresees a scenario where gold doesn't just hedge against volatility, but becomes the benchmark for value itself. As global markets unwind speculative excesses, capital will seek refuge in assets with intrinsic stability, and gold stands alone in that category. He envisions a time when the price of gold reflects not its mining cost or industrial use, but the true measure of global distrust, a mirror to the collapse of monetary illusion. In that world, gold's rise won't be a surprise. It will be the logical consequence of decades of financial overreach finally coming due. This shift may also spark a revaluation of global monetary systems. The next decade could witness the emergence of hybrid financial structures where physical assets like gold and silver underpin new forms of digital money, backed by trust in intrinsic value rather than political decree. Such a transformation would represent not just a price surge, but a philosophical reset, a return to financial realism after years of excess. Like this video if you found it insightful, share it with others who need to understand what's coming, and don't forget to subscribe for the latest updates on precious metals and the new monetary era that's already taking shape.